Welcome to our discussion of COVID-19's impact on tax and retirement planning. Steve Parrish and I are excited to moderate today's panel of thought leaders on the whirlwind of tax changes we've seen over the last few months. I believe everyone, myself included, is going to learn a lot over the next hour. And we'll start today's discussion with you, Bob. It seems like over the last 6 months, there have been a whirlwind of tax changes, and especially over the last month. What's the most common question you've been getting from financial advisors in recent weeks?
A lot is focused on, all the IRA rules, the FAQs that just came out. We've been working hard on that. PPP right now is kind of the center of the universe, and that will die down probably in 3 or 4 weeks. But right now, that's been where a lot of energy has been spent, and no one has much bandwidth outside of PPP.
What about you, Jeff? What have you been hearing?
Definitely hearing a lot of questions about the Paycheck Protection Program as well. In addition to that, a lot of questions about required minimum distributions, exactly what is waived for this year, what is not waived for this year, and then probably more than anything else, what do we do with the early year distributions that we don't want anymore? Can we roll them back? How do we roll them back, et cetera? That's been top of mind for a lot of advisors. Obviously, not the most pressing question when it comes to the urgency of the moment, right? Like we're talking about people who are so fortunate that they can put money back into their retirement accounts. But nevertheless, advisors tend to serve the higher income, high net worth individuals that these problems tend to have, they have in greater degrees relative to the rest of the population.
Right. Well, so why don't we go ahead and start with the CARES and PPP, and then we'll shift over to talking a little more about RMDs. I'll direct my first question. By the way, welcome, Jeff and Bob. Nice to have you here.
Thank you.
Jeff, let me ask, one of the things that we're hearing some confusion about is the fact that the government gave us, with the CARES Act, essentially access to money they otherwise wouldn't be able to access through the retirement plans before 59 and a half. But there's confusion about the loans from the 401ks versus withdrawals from the IRAs. So I think it'd be good to just have kind of a overview of how that works, and then we can go off of that.
Well, broadly speaking, there are 2 separate provisions there that apply. We're talking about one, the coronavirus-related distributions, and those are those distributions that can come from either a plan or an IRA, up to $100,000 in total combined from those accounts. And in order to qualify, you have to be what I like to refer to as either physically or fiscally impacted by the bill. So by the COVID crisis. So when we talk about physical, it's either you being diagnosed with the COVID virus, your spouse, or a dependent. And then if that doesn't apply to you, you can also qualify by being financially impacted. So if you were furloughed, let's say, you had hours reduced, you're a business owner and you've had to partially close. All of these reasons count, as well as, by the way, having to stay home to watch your children because you're not eligible or you can't find quality daycare options given the current environment. All of those individuals would qualify. And again, there's up to $100,000 that can come out of the IRA or plan. There are also as many as 5 potential benefits of those coronavirus-related distributions. So the first is that for those under 59 and a half, you are exempt from the 10% penalty. The second key benefit is that you can spread those distributions out by default over over 3 years. So for argument's sake, normally if you take $99,000 out of your IRA this year, you'd have to pay tax on $99,000 in 2020. The CARES Act says by default, if it's a coronavirus-related distribution, that will be split over 2020 to 2022 evenly, $33,000 a year. The third key benefit is that you can repay that distribution as a rollover for up to 3 years following the receipt. And then the fourth and fifth are plan-related benefits. Notably, the fourth option or the fourth potential benefit is that normally when you take money out of a plan, if there's a distribution that's eligible to be rolled over to another account, then the plan must withhold 20% of that distribution. So if you took 100,000, you generally only get a check for 80. Well, right now, cash flow is the name of the game. And so to make sure that plan participants requesting distributions get the cash that they need, that 20% withholding is waived. And then finally, separate from that, the coronavirus-related distribution can be its own distributable event from a plan, meaning that an individual who's still working and young may not have access to that money normally, the plan can be amended and they can be allowed to access up to that $100,000 via a coronavirus-related distribution. The key here, and a lot of confusion comes from the fact that plans don't have to allow that. Many are, and while the plan has to be amended, it can actually physically amend the plan up until 2022 or the plan year that year. So there is time to actually do the physical amending, but the plan has to essentially declare that we are amending our plan and will allow this. And then the plan loan is a completely separate provision. And perhaps Bob wants to step in here and talk about how that's also available, but separate to some participants.
Sure. Thank you, Jeff. That was a great analysis. Plan loans, fairly straightforward. You can borrow up to $100,000. They changed that. That used to be, I think, 50. And there's no more limitation of only borrowing half of what you have in the plan. So that's kind of where we start with plan loans. Now, the big thing, when Hurricane Sandy hit, I represented a gentleman on Long Island. He borrowed all this money and he couldn't pay it back. Okay, so that's one thing. The same gentleman also took money out of his IRAs and forgot that he would owe income tax on that. And eventually the government knocked on his door, and the IRS is a super creditor. They can take whatever they want. And it got real ugly for him. So if people are taking money out of their IRAs, talk to them about reserving, setting aside a reserve to pay those income taxes. Granted, you get a 3-year spread. If you take out, the example in the FAQs is if you take out $9,000, you report $3,000 in 20, $3,000 in 21, and $3,000 in 22. That's easy enough, but when you report it, where are you going to come up with the money to pay the taxes? Because when we're in a crisis, people want to deal with that crisis. They're worried about losing their home. They're not worried about how are they going to pay those taxes. So be very diligent. We really need to help people right now and make sure we're thinking. It's kind of like chess. You got to be thinking 2 or 3 or maybe 10 moves ahead and making sure that your clients aren't going to get themselves in trouble.
Yeah, Bob, you were able to give us FAQs that tell us how to deal with it. One of the challenges, let's move over to the PPP, is the fact that we never know where going because they keep changing it. So we know about 10 days ago, the IRS suddenly says you can't deduct the salaries if they're coming off of forgiven PPP loans. We got senators and congressmen saying, no, that's not what it's supposed to be. How do you deal with your clients on this constantly shifting that's going on, particularly with the PPP program?
Well, my biggest message is all this confusion will right itself. What you have right now is you have the SBA doing things that Congress should be doing. That 75% test, 75% of your forgiveness must be attributable to payroll, doesn't come from a statute. And we all learned at some point in time in school that the legislative branch writes the law and the executive branch enforces the law. Certainly right now, the executive branch is writing some of the law, and that will be undone by Congress. In the HEROES bill, Congress already has, this is the bill Speaker Pelosi released earlier in the week, she's already telling the SBA to take that statute out of, or take that regulation out of play. We're not, that's not something we gave you, take it out. It's right in the bill. And then there's fault on Congress's side too, because 6 members of Congress wrote to a number of companies telling them to return the money. And that's clearly an executive branch responsibility. So all these things, either through the courts or otherwise, will right themselves, but it's very hard to do planning. It's very hard to put everything on an Excel spreadsheet. And what we're really waiting for is for the SBA to come out with what are called the forgiveness regs. So we're up to 47 FAQs. They'll release the forgiveness rules. I don't know what those will look like, whether it'll be an interim rule or whether they're going to be more FAQs. But once we see that, that's going to go a long way to helping us. And we'll be spending a lot of time trying to figure out how to optimize the forgiveness.
Well, Jeff, let me kind of flip that question a different way. So you got all this going on. How is an advisor supposed to stay current on all this with it shifting so fast? How do you deal with that?
Well, there's really no easy answer to that question. That's a question that's been coming up a lot from CPAs, financial advisors, attorneys. Everyone who's trying to guide clients right now is trying to figure out, how do we drink from the fire hose that is all these regulations? And I really want to echo Bob's point. I think he made a perfect point there, that Congress has really abdicated a lot of its responsibility here. And I somewhat understand the original, especially with the PPP, I understand the original, CARES Act that was drafted in, essentially a matter of a week or two. And they had to get money into the economy to stabilize things to the extent possible. But about a month later, they followed up with a second bill that, added more money to this program. That gave Congress a month to fix these things, to put more of this stuff in the legislative text at that point. And they chose not to do it, which leaves a lot up to the administrative, function of the SBA, the Treasury, et cetera, which is not authoritative. Ultimately, it goes back to what the code says, what Congress writes. And not only are we seeing areas where it's vague, the law was drafted in broad vagaries, but beyond that, there are positions that have been taken up by the SBA that are, at direct conflict really with what's in the law. For instance, you mentioned the recent change or position that the SBA took, or rather Treasury, that the loan would be anything paid with the loan. You couldn't take a deduction for that. Well, the CARES Act says that the loan amount, the forgivable amount, is non-taxable. If you eliminate the deduction, you're essentially making the forgivable amount taxable. It's the same thing. So it's really a direct, conflict with what's in the statute. Again, things are happening at breakneck speed, so you kind of get some of this. I've never seen so much guidance come out. But in terms of how do you stay on top of it, I think it's really two ways. One is you've got to figure out where your sources are. So, one of the things that I do like on a regular basis every day now is make sure I'm checking, the Paycheck Protection Program FAQs. Make sure you're subscribing to the IRS and Small Business Administration updates that are available through those services. They put out some wonderful updates. And then, it's making sure that you're looking at the resources that are available in many cases for free. So, the American College does a great job of putting out updates. Bob does a ton of stuff through Lineberg Information Services on a regular basis to keep people up to date. Anytime there's a change, I'm out on Twitter in about half a second trying to, to get that out to the public as quickly as possible. So it's really a matter of finding what works best for you. The beautiful part of today is that we've got more access to information than ever before. The really hard part of today is that we have more access to information than ever before.
Since we have all this access to information, either one of you, we just had new information coming in on this whole idea of good faith certification. Mm-hmm. I think it would help the audience to hear that because that's pretty fresh stuff. Maybe start with Jeff on that.
Sure. Just last night, in fact, yesterday we had two separate updates to the FAQs. Early in the day, the FAQ 46, which is the one we're talking about now for the Paycheck Protection Program, was posted. And then later in the day, a second update came out, question 47. But question 46 is the really important one here for small business owners. What it did was it said that if you took a loan of $2 million or less via the Paycheck Protection Program, that good faith certification that you had to have made, essentially certifying that your loan was quote unquote necessary due to the economic uncertainty because of the current COVID-19 crisis, that if your loan was $2 million or less, you would be deemed to have satisfied that certification automatically. And I've got to tell you, while I understand the need for certainty for small business owners, I think that maybe that would have been better off kept internally as an enforcement guideline, as opposed to putting that out there to the public, because 99% roughly of the loans that are taken were of $2 million or less. What we're really telling people is like, yeah, you could have egregiously, you could have really stretched that certification to the nth degree. And as long as you didn't stretch it for a loan more than $2 million, which is a lot of taxpayer money, then you're okay. So I think it creates a moral hazard. It does create some certainty for small business owners. That's the good thing. But again, we're basically giving people a license to, and there's still funds available, like go get a loan, say you certified yourself for less than $2 million. And fraud is still on the table, but that's a tough bar, to prove, especially when your certification of being necessary is so vague. Bob, I don't know if you have any thoughts on, on that as well, but that just struck me as being, such a high dollar amount to grandfather or to rather to safe harbor everyone into.
Right. The moral hazard is definitely out there because people can still borrow. So there'll be people that are more aggressive in their borrowing. But here's what I was seeing. I had people that I've worked with, they were thinking of returning the money even though they desperately needed it because the government didn't define the word necessity. And if you had you could have defined necessity if you had put 15 random CPAs in a room. Within 4 or 5 hours, they could have come up with what is necessity.
Absolutely.
And that would vary a little bit from client to client, but we could have come up with something. But the Congress tended not to they didn't define it. And one of Mark Rubio's staffers said that if you didn't need the money during the 8 weeks, you shouldn't borrow it. And there's not one PhD accounting professor in the country that would tell you measure whether a business is going to go insolvent over 8 weeks. Mm-hmm. Now, some people might say a quarter or 6 months or a year or 18 months, but nobody would say 6 weeks or 8 weeks. But at the end of the day, they had to do that because now people that are under 2 million can not worry about criminal prosecution. I mean, part of that form was 30 years in prison. Mm-hmm. And it make people, now, the over 2 million folks, for that group, I think what they did was kind of what it was on my suggestion list is exactly what I had proposed to some of my friends at the AICPA earlier in the week, just to treat it like a tax audit. And if you mess this up, we're going to give you a chance to fix it. If you fix it right away, we won't penalize you. We're not going to fine you. We're not going to bring the Department of Justice in and put you in jail. Now, this is the problem. If they do an audit on one of your clients and that client has already spent the money, so they spent it on payroll, they spent it on rent, they spent it on utilities, they've done what they were supposed to do, and now they don't have the money, how are they supposed to simultaneously pay that back? And they're going to have to develop an appeal process when I'll call them the agent, the auditor, looks at that and says, pay me back. We're going to need another mechanism where if Jeff and I are helping that person, we can go, we disagree, can we appeal this? Because the auditors aren't always going to get it right. And there's so many variables. So there'll have to be another layer built into that. But as time marches on, I think the SBA and the Treasury will pick up on that. The AICPA, the leadership of the AICPA has been outstanding in advocating and bringing these issues to the SBA. So we should all be grateful for that.
Suppose, and before we leave PPP and CARES Act, Bob, I'm just curious, you and I have been through a lot of tax wars. How do we deal with the fact that this is costing the Treasury a huge amount? And so we know that there's going to be a lot of pressure on the government to possibly raise taxes. How are you dealing with that in your general planning, not just in the PPP, but with the fact that we are probably looking at tax increases?
Well, more Roth conversions, certainly, and then we're getting everyone ready to make very large gifts in November, December, depending how the elections go. I think everybody knows the drill. If the Senate swings and former Vice President Biden is elected President of the United States, we probably should react to that in a way to protect our wealthier clients. Because there will be good, bad, or indifferent, there's going to be big tax increases coming, and we can get ahead of that.
And Jeff, do you have anything to add on that? I mean, that's a tough one because you don't want to anticipate taxes before they happen, but come on.
Yeah. I mean, I've long said I thought taxes will be, higher in the future than they were, and I think that everything we've done over the last 5 years, only makes that more likely. The fact that we had the Tax Cut and Jobs Act, again, whatever your political feelings are about the taxes being low, good, bad, and different, we increased the deficit by another $1.5 trillion. Actually, those estimates now look pretty low. Now, with everything that's going on, I mean, I think April's deficit was in April, we ran almost $750 billion deficit in April alone. So, I think at some point we are going to look at tax increases. My big concerns are how will those tax increases come about? So, for instance, we've got a lot of people not working right now. That really hurts Social Security. Does that mean that we will see Social Security payroll taxes increase in the future? Because I love Roth conversions, right? And I'm a relatively young person. I believe my rate will be higher in the future. So I tend to stockpile as much money in Roth IRAs as I can personally, or Roth accounts. But that won't help me if, payroll taxes rise. That's not going to do anything for that. It doesn't do anything if we go to a VAT, for instance. And I'm not sold that we'll get to a VAT, but I could easily see payroll taxes being increased. You could see other things like surtaxes, like the 3.8% net investment income surtax being increased, or other taxes like that getting added on. That we just don't know. There's so much up in the air. I think you'd control what you can control. To a large degree, we've got unprecedented opportunity, as Bob mentioned, to transfer wealth for our wealthiest of clients right now. And we just don't know what's going to happen in November. If you took a poll today, or took a vote today, it's entirely possible that we could have a Republican House, a Republican Senate, and a Republican president come November. It's also possible that we could have a Democratic House, Democratic Senate. I mean, it's just so close right now. The country is so divided that we've just got to keep our ear to the ground. We've got to be hyper-focused and be able to react really in a moment's notice. One of the things I'm encouraging a lot of people is to kind of create your game plan for either scenario. For instance, the last thing you want to do is, if we have a scenario where it looks like taxes will likely be increased come 2021, or estate tax exemptions will be significantly cut, the last thing you want to do is, at that point, first start having to identify who are the people you need to, reach out to first. Do that planning now while you have a little bit of room. I know people are very busy with other things right now. It's a tremendously chaotic time, but we have to make plans and time for those things, so that if we have events that occur that are foreseeable, we can react as quickly as possible.
Your question or your answer is a good transition over to the RMD side. And Bob, let me ask you this. I mean, as both of you are pointing out, taxes very well could be going up. And great, we don't have to pay RMDs as early as we had to before, but that means you get this big accumulation hitting you. How are you dealing with your more affluent clients? Do they want to go ahead and take the RMDs anyway while taxes are low, or do they want to wait and get the time value of money?
What we're doing is we're doing a lot of what we call RMD Roth conversions. So let me give you the best example. Here's where it came from. Gentleman I've done work for 30 years. He calls me. He's 94 years old. He says, I don't have to take an RMD this year. What do you think about filling up that gap in my income with a Roth conversion? And I said, well, at least to the top of the 12 or 22% bracket, we need to do that. And so you don't want to let that 12 or 12% bracket lay fallow. You need to fill that up. And certainly for some wealthier people, you're going to fill up the 22 or 24. So we call those RMD Roth conversions. Now, of course, we can't recharacterize. And if we wake up in November, like Jeff said, and the government has swung, now the House of Representatives is controlled by the Republicans, maybe the taxes stay the same or they go down. But if you have outside funds to pay for your Roth conversion, and if you don't need the money after 70.5, it's a good idea anyway. So I don't know if I had answered it directly, but the RMD Roth conversions are a really good idea to fill up that gap, because you don't want to let that gap lay fallow.
Hey, Steve, just to add to what Bob was saying, I completely agree with all that. One of the things that I would add is that, as advisors, when we're talking to clients about their tax liability, clients are often hyper-focused on the short term. They look and they say, how much are my taxes this year? What is my bill going to be in April? Or how much will I get back in April? And the reality is, the hallmark of good tax planning is not necessarily to pay the lowest taxes this year. It's to pay the lowest amount of cumulative taxes over a lifetime. And often that means pushing income forward into lower income years. It means pulling income out of higher income years. And the big lie that a lot of people were led to believe, essentially, if you will, is that they'll be in a lower tax bracket in the future. And even if rates stay exactly the same, there are a lot of reasons why that may not happen. For instance, married couples is one of my favorite things to talk about, because if we take like the typical couple today, right? A husband and wife who are married, the man is typically, let's say, 2 or 3 years older on average. Every couple's different, of course, but 2 or 3 years older on average. On average, the man will die a few years younger than the woman would die. So let's say the spouse outlives, the surviving spouse, who will just make the wife in this case, outlives the husband by 7 years. That's 7 years that she probably has all the RMDs because he left her the account. She's probably got all the dividends, all the interest, all the capital gains, the higher Social Security check, maybe the survivorship pension. And yet she goes from having the nice, or they go together from having the nice cushy, quote unquote, joint brackets to now having almost all the income, except for the lower Social Security check, but in the single bracket, right? So that could dramatically increase someone's tax rate without any changes legislatively happen. So we've really got to look proactively at the future at what happened. And a lot of times what I like to think about the Roth IRA is I like to think of the Roth IRA in essence as tax insurance, right? Like I hope I have car insurance on my car. I hope I don't get into a car accident. I'm not hoping that happens so I make good on it. I have money in a Roth. I still hope taxes go down, right? Like selfishly, I'd like taxes to go lower. I'd like to pay less in taxes, but I've got an insurance policy there with my Roth IRA. It's the money that I know, at least for that portion, I don't have to worry about federal income taxes again. So I think that's absolutely critical for us to focus on the long-term picture is how do we keep our lifetime tax bill as low as possible?
Well,
one question that we've gotten from a couple of people who are watching is related to this coronavirus related distribution from an IRA and whether or not you can actually convert that into a Roth and then can you repay, and especially for people who are in a temporary low marginal tax rate year this year because business is slow, is this an opportunity for a Roth conversion?
Well, people are talking about that. Bruce Steiner wrote an article last night on Lineberg. So this is the general idea, the way I understand it. You take $100 out and you would agree to pay tax $33.33 a year. But then you would immediately roll that $100 into a Roth. And I actually spoke to Ed Slott about this. I think Ed and I are a little conservative on this and probably would like to see the IRS give us some guidance. And I don't necessarily want to speak for Ed, but that's certainly my opinion. But I'm curious what Jeff thinks. I mean, the idea seems to work, but is it wise?
Yeah, it's my position on this is echoes that. So I actually wrote an article about this last week, and I said, in my position, I actually cannot come up with any technical reason looking at the law why this shouldn't work, right? If you read the legislative text, it appears to work because the Roth IRA is an eligible account. But it's so grossly in violation of the spirit of what's trying to be done that I am not recommending it to anybody. The advisors that have reached out to me that have asked that question, I have counseled them to be very cautious. And if you're going to do it, make sure you get a tax professional's blessing, a tax advisor's blessing. This way it doesn't come back at you. I think it's very possible that at some point the IRS might look at this in a very similar way that they looked at the NUA to a Roth IRA back in 2009. I believe, and Bob, maybe you can check me on this, but I think it was notice 2009-75, if I'm not mistaken, that where the IRS said if you move the shares into a Roth IRA instead of a taxable account, we're going to treat it as if it first went to the traditional IRA and then went to the Roth IRA. And there's no legislative basis for them deciding it. There's no law that says if you do this, treat it as though it first went to the traditional IRA and then to the Roth. But it was clear the intent of Congress, and that's how the IRS chose to interpret it. I think we could see something very similar here. I do think, however, that, to the point I think you raised how Ed feels about these, I think while I agree with Ed and you on the position that I would not use the coronavirus-related distribution for a Roth conversion, I think Ed is also uncomfortable with using, at least last when I spoke to him, about putting back an RMD via a coronavirus-related distribution. And that's actually something I would feel more comfortable doing because I do think it's in line with the intent of Congress to be able to do that. Bob, I don't know if you agree with that or you would also take a more conservative position there as well.
No, I think if you've taken money out in terms of an RMD, as long as you're past whatever the date is in February, you're going to be fine. You should be able to roll that back. Maybe I'm not addressing that question correctly, but I'm not as worried about that. Congress said, and the IRS has said, we can put that money back in.
Mm-hmm. I think we agree. That's nice. That's a great, beautiful thing when you agree.
We did get a follow-up to that question, and that is if you have more than enough money in your qualified account, and this is basically going to end up as legacy anyway, would you not then withdraw the money to pay for life insurance if you're in a low marginal tax rate year?
Bob, you want to answer that first?
The life insurance strategies make sense. What I've been telling the CPAs and the lawyers and all the classes I'm teaching is that when that proposal comes in, take an honest, sincere look at it and run the math, okay? And my friends at some of the bigger life insurance companies have put together wonderful Excel models to demonstrate this, when it works and when it doesn't. People at one company in particular, Lion Street, have really found a policy that works very well, the design of it. So be open to the life insurance, but the life insurance is a very long-term plan. You're going to live with that till the day you die. So I wouldn't let the 2020 events we're going through drive that decision. I'd make sure it was a rock-solid decision anyway, and then take advantage of the short-term opportunity we have this year. Maybe you can do some really great upfront funding. So maybe if you could take out that $80,000 RMD and put it into the life insurance policy to get that started, that might make sense. Jeff?
Yeah, I think that's spot on as always. And I would add there that, really this is not a new decision. Essentially, if you're looking at life insurance as a legacy play, what you're really doing is looking at it as an investment play. And the reason I say that is because if you want to take money out and create tax-free legacy, you can do that via a Roth conversion. And the same money that you take out to pay the life insurance premium can go into a Roth IRA. So what you're really betting is that I'd rather have my money in this life insurance that perhaps is guaranteed. It may be that you're comfortable with that rate of return based on, the internal rate of return based upon your projected death, in comparison to taking the risk of investing it in the markets yourself. But at the end of the day, it's really an investment decision because you have the ability to generate tax-free dollars in the Roth, the same way you do tax-free dollars via life insurance. And I would further add that while life insurance oftentimes has the benefit of a guarantee, it also has a downside compared to the Roth, which is that with the life insurance, the proceeds, the death benefit, are going to be tax-free, right? In general, at least the $1 million, let's say you have in a policy, will be tax-free. But the next day, if that's in an ILIT, you're going to be taxed on trust tax rates on the earnings, or that'll get passed out to the trust beneficiaries and they'll pay taxes on their own rates. Whereas if we have that in a Roth IRA, it's not only the amount that you inherit that's tax-free, but in most cases now, thanks to the Secure Act's 10-year rule, you could have that go over another 10 years, leave it in the Roth, and then take it out 10 years later, which if we're just thinking about, rule of 72, let's make a hypothetical 7% rate of return over the 10 years. Michael, you may have some feedback on that, whether that's realistic or not. But, if we use a 7% rate of return, the money doubles. So the $1 million turns into $2 million tax-free if you leave it in a Roth, versus if you have life insurance, it's $1 million tax-free, and then after that, it's all taxable. You could always go into municipal bonds or something like that, but in general, you're subject to regular tax rules on that death benefit once the policy matures, if you will.
Let me ask another long-term planning strategy, and that's the whole idea of because of the Secure Act and inherited IRAs essentially being largely taken away. And Bob, I imagine you're running into this a lot. So we have all those conduit trusts sitting out there that we're going to solve the world for inherited IRAs, and now we're basically screaming, change them all right away to accumulation trusts. But as Jeff pointed out, you're sitting on this high taxation of trusts. How are you, what are you recommending these days for inherited IRAs when there's going to be enough money left over to deal with it?
Right. Well, the first thing is recognize the very good point you make that conduit trusts probably have to be corrected because they do not fit from a property law standpoint anymore for many families. So you're going to either draft that trust as a 678 trust where it becomes a grantor trust with regard to the beneficiary. You're going to do Roth conversions before someone dies. So anyone that's going to be funding a special needs trust and you're going to be retaining funds in there for sure, you're probably better to have mom and dad do Roth conversions at a lower rate and then have everything pass, have the Roth pass to that trust. Thirdly, can you do the life insurance substitution that Jeff and I just elaborated on? And then fourthly is can you set up that trust so you can spray income across many beneficiaries? In other words, the trust is for all my grandchildren and they all happen to be 24 years old or older, avoiding the kiddie tax, and I sprinkle it out to them. That might be, those are kind of the four options.
Makes sense. Let me ask one other short-term planning, because both of you have made the point that everybody's kind of focused on the short-term stuff. QCDs. Okay, so qualified charitable, those are great, but there's also some traps. Jeff, I know you've done some writing about that. Where are we as far as short-term planning on using qualified charitable distributions on the RMD?
Sure. I think qualified charitable distributions are one of the best, if not the single best way for individuals 70 and a half or older to give to charity. And a lot of that comes down to the fact that they're pre-tax dollars. They're always going to be pre-tax dollars. If we look at the comparison of should you use a QCD versus, let's say, appreciated stock, which a lot of people like to use. Well, there are a couple problems with giving the appreciated stock. The first is that if you die with it and it's appreciated, you eliminate the tax liability, right, with the step up in basis. So there's a possibility of getting rid of that tax for your heirs, whereas with the IRA, it's going to be there. Someone is going to pay tax on those dollars. But the second issue is that even for a lot of people, they're not getting any sort of benefit today from their charitable contributions. And the analogy I use here goes back, is kind of a silly one in some cases, but it goes back to the football game, the Super Bowl from a number of years ago, when the Falcons were playing that team with a P. I won't say their name. I'm a diehard Steeler fan. Bob, I know you're a big Green Bay fan, so we can all agree no one likes that team, right? Like, I probably just lost half the audience, sorry. But, with that said, what happened? Well, one team, the Falcons, were crushing the other team at halftime, right? And the amazing thing is it's a historic game. It's the Super Bowl, and nobody ever really remembers what the score was at halftime. In fact, Mike, Bob, Steve, anybody happen to remember what the score at halftime was?
I watched it.
I did. I watched it too. And I bet you probably most people listening, if they have a guess, they're going to say 28-3. That's the most common guess when I asked that question. It was actually 21-3 at halftime. The Falcons scored early in the second half, made it 28-3. And then the other team did all the bad things that they did. So why do I bring this up, right? What do I talk about a Super Bowl from years ago for? Well, because I would ask, what happened with the score at halftime? Was it important? And the answer is absolutely not. Like, who cares about your halftime score in anything except when it comes to the tax return? If we think about the tax return in terms of a first half and the second half, your first half is really AGI, right? Like, halftime is your AGI score. And the qualified charitable, or rather your deduction for charitable contributions, your regular itemized deduction, is really a third or a fourth quarter expense. It happens after we calculate AGI. It happens after halftime. But when we look at things that are based on AGI, think of every single credit that's phased in or phased out. Think of every single deduction, with perhaps the exception of the qualified business income tax deduction. Think of all the things that aren't even tax related, like Medicare Part B premiums. All of these things are tied to the halftime score. So if you give $1 billion to charity as an itemized deduction, it does nothing to help reduce your Medicare premiums, does nothing to help stop your 3.8% surtax, all of these types of things. And on top of that, even for those who are, that's even for those who are lucky enough to itemize in the first place. The Tax Cut and Jobs Act roughly doubled the standard deduction for most filers. So if we look at, let's say, a married couple who are each 70 and a half or older. Well, if you're 70 and a half or older, you're certainly over 65, which means you not only get the standard deduction, but you get the additional standard deduction on top of that. So this year, you need $27,400 of itemized deductions before you equal your standard deduction. Let's give you $10,000 of state and local income taxes or property taxes. Take your SALT deduction is $10,000. Where's the other $17,400 coming from? If you're 70 and a half and you're high income, high net worth, you don't have a mortgage anymore. You probably paid that off a long time ago. You don't have medical deductions because your income is high. It's hard to beat 7.5% of AGI when you've got Medicare and a good wraparound and like the things our clients have, which means it comes down to charity. And while a lot of our clients are very charitably inclined, giving away more than $17,400 a year is uncommon for a lot of people, especially today, which means the QCD is even more valuable today than perhaps ever before.
I'm going to take it you're saying you like QCDs. We know.
Not at all. No. Don't do it. No.
I love your analogy about the football game. And Michael, I don't know if there are any other ones in the chat box right now. I have some operational questions, but are there any follow-ups to that we need to be aware of?
Well, one question that I keep getting over and over again, Jeff, is can you please relist all the sources for advisors to go to get updated information?
Sure. So, I mean, I'm obviously going to be very biased here because of the sources I rely on. So clearly the American College has some amazing resources out there. So make sure you're paying attention to what's put out. I mean, even, web conferences like this are phenomenal ways to keep your education up to date. Bob does a lot with the AICPA and the PFP section there. There's lots of good information there. I think, Bob, is it weekly, the AICPA's podcast for the PFP section? Or the PFS?
Yes, but also the AICPA has a coronavirus resource center, and the IRS has a similar resource center. And we'll keep going, Jeff. Let's finish your list first.
Sure. Bob also does a lot with Lineberg Information Services. It's a great resource. You basically get daily emails on advanced planning topics. It's something that I rely on. I always, get to always learn something from a lot of the great experts that are there. And then I write quite a bit for kitsys.com, the Nerd's Eye View. Many people are familiar with that site. We have done a lot on the CARES Act and Secure Act, et cetera. And then really going to social media. Social media has become a place where, whenever the Treasury puts out something, they tweet about it, or they put it out on LinkedIn or wherever it is. So, follow your sources. Like I mentioned, if people, for instance, just, being selfish, if people were to look at my my Twitter feed, if they go to the profile, the first thing they'll see is the pinned tweet is a 56 tweet string breaking down the CARES Act the night that it was released, the night that it passed. So it's finding who you want to rely on and who resonates with your learning style. But again, social media is a great way to do it. Building lists via social media. So you can have like Twitter in particular, I find is very useful in this regard, where you can have your go-to sources on updates and just check it, once a day, once a week, whatever it is. But there's unfortunately no shortcut to learning, and there's no shortage of things to learn right now. So it is a challenge for us all. But that said, I think Bob had some other areas or some other resources that he wanted to highlight as well. So let me make sure I leave time for Bob to do that.
Just real quick, the IRS has set up their own resource center. If you Google U.S. Treasury front page, it's a little unusual, U.S. Treasury front page, that will bring you to the Treasury website. And right above the picture of Secretary Mnuchin, there's a hyperlink to all the documents the SBA has put out. And that's what Jeff was researching or mentioning earlier, that we can go there and the FAQs are out there, all the interim rules. It's a lot easier than organizing all this stuff yourself. So, and then AICPA Resource Center, IRS Resource Center, Treasury front page, those are all great places to look.
Okay, and I think we said it earlier, but also Lineberg and Lissy and all the great things that are coming out there as well. So let's get over to the operational side of this. So a lot of us, including me, have not filed our return for 2019. There's still some opportunities. Why don't you, Jeff, since you raised your hand, why don't you remind us of some of the opportunities and some of the pitfalls as far as those of us who haven't filed for last year?
Sure. I haven't filed yet either for a variety of reasons. And I think the biggest thing is just to be aware of the deadlines. They continue to move them. I actually spoke to a client last night. They were concerned. They were going away for a month, and they weren't sure whether they were going to make their Q2 estimate on time by June 15th. And I said, well, no, wait, that got pushed back too. And they had seen the earlier announcements about the original filing date and Q1 estimates getting pushed back to July 15th, but they had missed the later announcement via, I think it was Notice 2020-23, that pushed back the second quarter estimates to July 15th as well. So the big thing, of course, is making sure you're filing on time. If you have the ability, you should always pay your taxes on time as well. That's very important because, as Bob mentioned earlier, the last creditor in the world that you want after you is the IRS. That said, if you can't, right? Like we all know that these are unprecedented times. We've got millions of people going on unemployment every single week. It's possible that someone may not be able to pay their taxes. Don't use that as the excuse not to file. filing is always more important than paying. Not that paying isn't important, right? But there's an opportunity to set up payment plans or a variety of different options that taxpayers have if they're having trouble paying the bill on time. But not filing leads to dramatically more severe penalties than filing and not paying. So I would say that's probably the one biggest trap that I would advise people to be aware of. And in addition to that, just note that, a lot of advisors may have clients going on to unemployment for the first time in their lives. And people just don't understand that unemployment is taxable income. And that's even more important to be aware of today than ever before, because unemployment checks today are higher than they ever were, thanks to that pandemic, some of the extra boosts that come to unemployment via the CARES Act. There's that $600 additional monthly payment on top of a state's regular payment. And the average state payment for unemployment is about $380. That's about the ballpark. So when we're looking at adding $600 a week on top of that, we're basically increasing it by 150%, almost $1,000 a week in the average, for an average state check right now, which can add up to some real significant taxable income. If people are not aware of that, that may surprise them. So I think that's worth noting as well.
Jeff, one of the questions we've gotten related to unemployment is, can you get unemployment and a PPP loan at the same time?
There's nothing that's in writing on that. However, in conversations with the SBA and some Treasury officials, my understanding, and also some states, is that you cannot. But to be very clear, the PPP for a self-employed person is only going to cover like 8 weeks of payments. And so you would not want to be on unemployment during those 8 weeks, but certainly before you receive the PPP loan or after you finish those 8 weeks of paying yourself, if you will, via the PPP, I think you would then qualify for the unemployment, with the caveat that this is, again, administered by the states. So it's still subject to state rules. And those state rules for those self-employed persons may vary. For instance, I spoke to one person, they were advised by their state not to conduct meetings with clients while they were on unemployment, because they said that would show active employment, and whether they were making money or not, it really didn't matter, according to that state's unemployment division. So know your state rules, but I think the answer there is, it would be pretty unlikely for anyone to think that you could get a loan to pay yourself to quote unquote stay in business and also receive unemployment at the same time.
And Michael, as we start approaching the end of the hour, I just want to make sure I ask a big picture question to our two panelists. Bob, so obviously there's a lot of interest in estate planning. There's a lot of interest in financial planning. A good friend of mine that's an attorney is literally starting to do their estate plan appointments for August. So give us an idea of where you see the landscape for financial planning going in the next year as a result of COVID-19.
Well, there's no doubt that a lot of people want their plans updated. They've lost quite a bit of money and they want to know, what does that mean? How much do I need to cut back? So that's out there. The changes in the tax law potential after the November election are massive. So of course we want to take that into account. The potential of seeing your exemption go from 24 million in round numbers to 12 or less is going to drive a lot of people. There's a lot of people probably on this call that at 24 million, it's just not a concern. But at 12 million, you can see 12 million from where you're standing. And they're going to be very concerned, especially when you add in life insurance. So I think we're going to see a very big second half of the year. I think we're still going to have all of this. What we haven't talked about at all is all the science. And we're being very naive if we think social distancing and meeting with people in our offices is just going to come back in June sometime. It's not going to happen that fast. Landlords in big cities, I heard this in 3 or 4 big cities, are not letting visitors into their offices, meaning they'll let the employees of those firms go back, but if one of their clients wants to come in, it's not happening. And so you're going to see many, many restrictions here, but it still means we're going to be very busy. Amazingly, how quickly we've gone to working on video phone and phone calls without seeing people, which is, of course, sad, but it shows you just how resilient we are and how dedicated people are to taking care of their clients.
And what's the nerd's eye view on where financial planning is going to be in this next year?
Well, I think it's going to continue to evolve at a very rapid pace. I think the one thing that we can count on really here is change. It's a cliche, but probably has never been more true than today. I can't think of a day that's gone by where I haven't seen something from the IRS or from the Small Business Administration or from somewhere to update some sort of information that we thought was different the day before, or we were unsure of the day before. So I think it's just a continuing to be very cognizant that we're in the early innings of this. There's going to be a lot more economic damage to come. There's going to be further stimulus bills. I took a look at the House bill that came out. It was 1,815 pages and $3 trillion. And I don't think it's going to, I think it's pretty safe to say that it's not going to pass the Senate as is. But it is an early indication of what is, on the horizon and what will be needed or requested by Congress. And so we're likely to see a lot more things happening. We could see RMDs retroactively waived for 2019. I mean, I can't think of a bigger disaster from an operations standpoint of view. I mean, I am selfishly hoping that doesn't happen. Waive 2021, but don't go backwards in time. My goodness. So there are these, we just are going to have to be more diligent than ever before about staying on top of this. I feel for the CPAs that are in the grind. This is the tax season that literally will never, ever end. So, it's unprecedented time. It's going to take the work, but I think Bob made a really great point that I think this really shows how deeply concerned advisors of all sorts, attorneys, financial advisors, CPAs are about making sure their clients are in the best possible position. I've received more questions from CPAs and financial advisors by probably 10 times than I ever have in my life. And it just goes to show that there's a hunger for that knowledge, a hunger for that information to make sure they're passing along the best possible information and guidance to their clients, which is great. Ultimately what we're here to do.
And I think before we end, there are a lot of advisors who are wondering if they're eligible for PPP loans. Mm-hmm. Can you address that and ADV disclosure issues? Those have been coming to mind for a lot of advisors.
So I think that the Q&A 46 really provides a window for advisors who want to take these loans that was not there before, because a loan of under $2 million is going to cover just about every advisory firm. We're looking at 2.5 times average monthly payroll. So if do some quick math, that's like $800,000 of monthly payroll. Which would be a big number for an advisory firm, right? Not that there aren't those out there that run payroll higher than that, but that covers the overwhelming majority of firms. So I think if firms want to apply, they can to a large degree, but you're still making that certification. You still got to comply with the ethical part of this, which is that if you're taking that money, it's coming from somebody else, right? There is an ethical component here that every dollar you take is going to be taken away from. It's not an unlimited supply. It's not like the Paycheck Protection Program just has unlimited funds and everybody can apply and whoever applies gets it. It's a limited supply from Congress. We had $349 billion the first time. We added $310 billion the next time. It's going to run out probably here in the next few weeks. And a dollar in your pocket is a dollar out of someone else's. Now, I can't tell someone how to go about that. I don't know how bad they're hurting. But in terms of if that loan is received, if it's received by an individual who, let's say, is FINRA licensed and they have a U4, then FINRA has come out very proactively in their FAQs and said, no, we don't view this as a compromise with the creditor. There was some question as to whether, question 14K on the U4, which asks, have you compromised with the creditor? There was some question as to if you get your loan forgiven, is that a compromise with the creditor? And FINRA's position was because the forgiveness is part of the initial terms of the loan itself, it would not be considered a compromise with the creditor. But the SEC has taken a less firm position. What they said was that if you're looking at item 18B on part 2A of your firm brochure, which is the item that asks essentially, about your financial well-being, and specifically you have to disclose certain items if you are if you have discretionary authority over clients' assets, or you bill certain amounts more than 6 months in advance, et cetera. There are some items that are listed out there. But in short, the SEC has said, if this is material for your firm, and again, I think that it's hard to argue that on one hand it's material to the SEC or not material to the SEC, but on the other hand, to the Small Business Administration, you're saying this loan is necessary. Well, those kind of conflict with one another. So you'd have to consider making that disclosure there. The one thing that the SEC did say was that if this loan is being taken to pay the payroll of people who perform primarily advisory services, then that should be disclosed. That would be material. So they gave an example of where, yes, you would need to disclose it, but they left open, beyond that to say, well, if it's material, if it's not this, but if it's material, you should still disclose it. So that's one area where you may want to rely on your compliance consultant or your compliance attorney to give you personalized advice. But I got to say, I would tend towards airing that, disclosing that, putting it in the best possible light on your ADV, but putting it out there this way, you have no SEC issues down the road. I think the possible repercussions of being wrong there and not putting it in your ADV are more severe than the potential issues you might have by putting it in your ADV and making that publicly known, because I think it's going to be publicly known anyway. I think, you're going to see a Freedom of Information Act request here, and the businesses that take these loans will become public at some point or another. I think that's likely.
Oh, my side of that, I see no reason why financial advisors, insurance advisors can't go for the loans. The issue becomes the ethical issue. If you're not affected by this at all in any way, is it right to go for that loan? And that's a question you just have to wrestle with. The problem is, because the science is developing so fast, no one knows how they're going to be impacted. That's the problem. That's why people are taking these loans, even though they think they'll be okay. There's so much uncertainty. And there's just, when do we get a vaccine? Will they come up with a therapy that works on everyone? Those are the big questions, and we've been watching the science side of this very closely, and it's really scary.
Yeah, and I think that's the bottom line. For many of these strategies, we just don't know how it's going to play out for the rest of the year and even into next year. I want to take a moment to thank you, Jeff, and thank you, Bob, for your time, and thank you, everyone, for attending. This was the third in a 4-part webcast series, tackling COVID-19's impact from all angles. 2 weeks from today, May 28th at 3 p.m. Eastern Time, we'll dissect COVID-19's impact on wealth management. If you're listening to this, you're already registered, and you'll receive a reminder email the day before the webcast. Thank you again, Steve, Jeff, and Robert. Be safe, be well, and continue to be the pillars of guidance for your clients and your communities. We'll talk again on May 28th. Thanks, everyone.